Hi Team Value, JJ here. Welcome back. Well, today I have a bit of a warning for you of sorts. Now, I've been looking around. I spend every day on YouTube. I'm making content for YouTube, and I see other finance YouTubers, big YouTubers with hundreds of thousands of followers, and I see, CNBC and Bloomberg and the people on there. And what I'm noticing is that people are becoming increasingly bulled up, increasingly confident, and on X too. I've seen these YouTubers who it's almost like gambling mode, or is extremely, bulled up about what's happening in the stock market. And today I want to look at what people are predicting and what's just been happening. It does involve Jamie Dimon and someone that works with him that just got sacked, a chief strategist. And it involves some of the biggest bulls on Wall Street. Their predictions, people try and predict. And really, that's the warning. If you've seen my videos before, I talk about the folly of predicting in the short term. I mean, perhaps we can predict the stock market over the very long term that it's going to go up. But there's a lot of people need to make content about something, and there's a lot of I told you so going on about with bulls at the moment. And so let's just have a look. So this is this one guy, Tom Nash. He's got hundreds of thousands of followers. I don't think Tom Nash is actually his real name. I think it's a pseudonym, and not sure where he lives. Might be Australia. I don't know. But anyway, let's see what he's saying about this recent development.
Folks, it started. As I predicted multiple times, heads have started to roll. Kolanovic, which is not a household name for most of you, but this guy was a superstar chief market strategist for JP Morgan. And his boss, by the way, is one of the biggest bears in the market, Jamie Dimon. This guy was just let go. Now, I told you multiple times that in the second half of 2024, this is going to start happening. Heads will start to roll because the bears that have cost their clients a lot of money will pay the price. And Kolanovic is just the start. Just to kind of show you who this guy is, he used to be a superstar, but...
So he's saying, I told you so there. He's been saying he's been pretty bullish. He's been bullish along with another person that I make videos about before. It's Tom Lee from Fundstrat, who's been making pretty, some would say outrageous kind of predictions. He's making one prediction which we'll look at, that the stock market's going to go up 20% per year to the end of the decade, similar to how it did, really in the 20th century, the beginning of the 20th century, which, as we know, led to, it was the Roaring 20s. So there's people calling for Roaring 20s prediction. And now people are talking to this chief strategist with JP Morgan, and Jamie Dimon was his ultimate boss there. And he was let go for making some bad calls. He was pretty bearish, didn't work out. And so, these different analysts predict things. And so people are pointing to this as, someone like Tom Lee is right. Dan Ives has been right. Another sort of very bullish analyst, that they've had a good run because we're in a bull market, and people who predicted a bear market are on the way out. But my point here is that I think it's foolish to predict either way. It's these people's jobs, or is it their people's jobs? The chief strategist, we'll have a look at an article to see what he was predicting, and it was really pretty much over the short term. Imagine if Warren Buffett was fired from the CEO. He can't be fired from Berkshire Hathaway, but imagine, he's had a string of not so great years underperforming while there's been a bullish tech market, and then, it's come back. So this is kind of shows you the folly, and Charlie Munger and Warren Buffett have talked about this. They said because they were around for decades, the late Charlie Munger now though. But they were around for many decades. They've seen these people come and go, these people who try and predict, and consultants, and they might have a good run for a while, but trying to predict the macro and with the market direction over the long term is impossible. I can say that there. This is not financial advice, and I'm not predicting anything. I'm just, this is just for entertainment and general education purposes. But as I said, because I'm on YouTube every day, I don't consider myself a kind of typical YouTuber in this sense. I see people making predictions, short-term predictions on stocks, short-term predictions on the market. And I just, it's my warning is to to not listen to these people. I'm not giving financial advice, and I don't think that they should be giving advice and predictions either. So anyway, let's continue on. It's my little start off rant, but let's get into it.
A year ago, he said, hey, we're looking forward to an outright negative stock performance. That year cost his clients 25%. 8 months ago, he doubled down and he said, we're looking forward to a 20% plunge. From that point on, the market has done 34%. So this guy cost his clients 25% and 34% ever since he started making these predictions over the past 18 months. And now he's paying the price. It's not a surprise.
So this guy has made some bad predictions, and I guess it was part of his job. It's crazy that his job was as part of his job to make predictions based on their clients' money. As Tom said here, he lost a lot of money, and the people that were bullish gained a lot of money here. But the fact that it's his job to predict, an impossible job. But the thing is, this guy had a very good run before that, in which we'll see a bit later on. He had a good run, so he was kind of golden, and then it went bad. So this is what Charlie Munger was saying, that it can go well for a time if you're predicting, but to do it consistently over the long term is very difficult. So some people who are being bullish at the moment and recently are doing well. So it's, I mean, as Howard Marks said in a video I made just before, a few days ago, when he made an interview, was saying that he doesn't predict, he takes the temperature of the market. That's all you can do, but not sort of predict what direction it's going to go in. You can take, is it too hot? Is it too cold? And other stocks we're looking at, are they the fundamental sound, or is it too expensive based on intrinsic value? But, you know, investing based on the market and predicting where the market's going to go is impossible.
Literally what I told you is going to start happening. There's an agency here. If you're the chief strategist, if you're managing money and you've made a mistake after mistake after mistake, and you've cost your clients potential profits of 30, 40, 50% while you kept them in the 5% money market accounts, you're going to pay the price. And your career is going to be effectively over, because this is not the sort of business where people forget.
People have a job to do, and that job is to earn.
This is Josh Brown. He's from the Compound, and he appears on these programs too. He does predict one way or the other as well. He's another one that does predictions.
Return on the capital that's been entrusted with them, and that is a huge driver in the second half of the year in both directions, right? So we saw a washout in October of 2022. This is the reverse version of that. Now you have the Dow, the Nasdaq, and the S&P 500 as of noon today, all making all-time highs together. It's a fairly rare phenomenon, but when it's taking place and you're out of the market and or underweight, it's deafening. You cannot sit there and watch that go on, and not just because you feel a certain way, but there's an agency problem in investing, which is when you're running money for other people, they have expectations, and one of those expectations is you better not trail the SPX.
Now, for the past few
this is a difficulty with being a fund manager, and I would not like to be a professional fund manager. I'm not a financial advisor. This is not financial advice. Because you can trail the market for a time that could be years, and then you can make a comeback, you know. And if you're trying to make predictions, if you tell your clients, and the clients start saying, you know, why aren't you invested in Nvidia, for instance? Why aren't you invested in Nvidia? You made a mistake there. And so they pull their money out. And sometimes, as the stories go, especially like with value investing funds, quite a lot, is that people pull their money out, and you know, then the market, then it turns, and so they just haven't been patient enough. And Peter Lynch said this, or somebody pointed out about Peter Lynch's fund. Peter Lynch had a fantastic run, but his clients, a lot of his clients didn't make those returns because they were pulling money in and out at the wrong time. So the market went down, they're pulling it out, or you know, he's lost it, and then you know, so they weren't patient. And this is the problem with this kind of attitude. Okay. So the next one is now Joseph Carlson. So I did a video about talking about what he was talking about, and he's also very bullish. He's in these big tech stock, US tech stocks, but he agrees with Tom Lee, as Tom Nash agrees with Tom Lee about the market, and Tom Lee's got some predictions that the market's going to compound 20% a year to the next decade. So let's just see a snippet of what Joseph Carlson says.
Bears and bulls. The most notable bull in the market is Tom Lee, and he's becoming increasingly popular. If I was to measure the rise of Tom Lee and the popularity of Tom Lee, it is directly linked with the success of his calls. He is becoming more popular for good reason. He's correct, and he's consistently correct about things that many other people are wrong on, specifically price targets for the S&P 500. I've noticed the rise of Tom Lee over the past few years as he has made non-consensus correct calls. Back in 2020, 2021, 2022, 2023, he has been calling for seemingly outlandish price targets of the S&P 500 surging upwards more and more, while other analysts in consensus were saying, no, the economy is going to go down. The stock market's going to enter into a recession. We're going to have stagflation. We're going to have all of these issues. Tom Lee has said, no, no, no. These are going to resolve. The market's going up. We have ample liquidity. The economy's strong. And he's been correct. He's hit price targets that people thought were nearly impossible, or at least silly. And since he's done it so well and so consistently, now more and more people are paying attention to him. Let's go ahead and take a look at his most...
Okay, so here Joseph, he does say during this video that he, near the end there, that he is more likely to agree with Tom Lee on the, that the market's going to go up, and over the very long term, that's what has been the history of the stock market over the very long term. But Tom Lee makes these very short-term predictions, but he's making long-term predictions as well. And in a bull market, the bullish predictions are going to be right. So my warning again is to just, I think, be careful of anybody who tries to predict any kind of thing in the market. And, the whole finance media is kind of based on this, and you will get views. I mean, I'm unlikely to get a lot of views giving this kind of warning, because people say what you want to hear. It's confirmation bias is real. Charlie Munger talked about this, the different biases we have in investors. And, in bull markets, people get more bulled up and more bulled up. And as Howard Marks says, one of the biggest mistakes investors make is to think that things won't change. So, the bull markets can change unexpectedly, and we saw that with a pandemic coming along. All right, so let's move on. This is getting pretty long. So this is Jamie Dimon. So he's the guy that the boss of the guy who was let go from JP Morgan. Let's see what he's got to say. He's been fairly bearish.
What do you think the future is for inflation and interest
I'm a
rates?
little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. The remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year. And I think the chance of inflation staying higher or rates going up are higher than other people think. So whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Okay, so this is from Tom Nash again, who pointed to this, and he kind of refutes what's going on. But Jamie Dimon has been fairly bearish. He's been one of the bearish ones, so he's been making predictions. And this strategist that worked for JP Morgan Bank was the one that was let go. And we can see here Marco Kolanovic, or Kolanovic, depends how you say that. You can say it different ways. Will leave his role at JP Morgan as the chief global market strategist after 19 years stint. So this is after 19 years, culminated in a series of mistimed calls in the US stock market. So this is brutal. He was there for 19 years and he had a good run, and then he made some bad calls over an 18-month period, and he's out. It's brutal, this kind of investment banking environment. It was bank's co-head of global research, was among the few bearish strategists left on Wall Street. And the saying goes, when the last bear is shot, that's when you need to worry. So there's a lot of consensus going on. On the other hand, Howard Marks says, the consensus is usually right, and you have to pick your time to be contrarian by taking the temperature of the market. So as I said, you can, any particular time, you can see predictions one way or the other, and historically we can go back and say, oh, that person was right, but it's usually different people over a period of time, and this guy was right for a while. He made some bad calls and he's out. Once up, the man who moves markets, and Gandalf his star has fallen in recent years, so he was doing well and he didn't. A series of contrarian, ultimately mistimed calls. 2 years ago, he advised clients to take an overweight position in US stocks during the deep bear market sell-off. So this was in 2022, before switching, recommending to an underweight position in 2023. So in 2022, he advised people to buy during that bear market and was correct, but then changed his mind. So this is the difficulty with predicting on the macro and the market level, rather than, looking at the companies, looking at fundamentals. And it talks about his history there, and it says he's now exploring other opportunities. And it does say that he had a really good run. He was included as an Institutional Investor Hall of Fame in 2020, following 10 consecutive years of number one rankings. So this guy had a decade of good results, good predictions, and then suddenly it went wrong. He's described as an awful lack of breadth in the US stock market. He reiterated their bearish outlook. So, JP Morgan, Jamie Dimon was bearish, and this chief strategist was bearish. And it's gone wrong for this guy after a reasonably long time. And Tom Lee's had a good run of a decade. He was wrong in 2022. People forget that. So, these predictions, again, I'm saying just be careful of predictions is my thing. And let's see what Tom Lee's got to say. He's got, it's pretty outrageous what he's saying here, that the market's going to be pretty much 20% compounding to the end of the decade, like the Roaring Twenties. Let's hear from his own mouth.
Tom Lee, good to see you.
Great to see you, Brian.
You have not been drinking.
No,
Okay,
not
yet.
recently.
Not recently. 15,000. I'm just going to sit here and listen.
Okay, well, there's a couple of reasons behind this. One is this would be the third time that stocks entered a cycle where annual returns compound at high teens. You had the Roaring 20s, and then you had the 50s through the late 60s. And this is a third cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
So is this the law?
All right. So he's basing it on this, this call of generational. It's really a generational thing that he's basing it on here. And yeah, I'm not saying he's going to be wrong. He could well be right, but it's just the fact of investing based on this, which is he's obviously doing it for his clients, and he might be right, but he might be wrong as well. We just don't know. Let's carry on. By the way, if you're getting value out of this, if you think you're getting value out of this video so far, do smash that like button on YouTube to help the algorithm to spread it to more people, because that's what we want. And do subscribe if you want more of this kind of content in the future.
Okay, so
rather than just short-term predictions and where the market's going to go.
Math. I wasn't not great at math, but I'd like to think I know a little bit. Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years.
Yeah, so it's a
demographics.
Exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. On top of that, we have a really big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
So it does make some kind of sense, and it always does when people give predictions one way or the other. It kind of makes sense. So he's saying that the US tech companies are going to remain strong and the US is going to lead, and that's going to lead the market up 20% a year, which would be amazing if that happened throughout for the rest of the decade.
Do you have a view? Is this because we're the United States? I mean, and do you expect that a lot of money from around the world, because China's got massive demographic issues, Germany shot itself in the foot with all of its energy problems, will we be helped by a lot of money coming into America, or does that have nothing to do with it?
It's actually both. I think that there's going to be a lot of dollars spent on U.S. technology products because the world.
There's this prediction there written down in black and white: 20% annual increase from now till 2030, earnings growth contributing to that, to the total.
Short
12 to 15% of that total earnings growth contributing. So there. I don't think we need to go any further. That's his prediction. This video is getting long. I think I've made my point here that just predictions can be right or wrong, and somebody can be right for even more than 5 years. As that guy that got let go, he had a 10-year run of great predictions. Tom Lee's having a good run because the market's been mostly bullish, but it's just, I think it's a dangerous thing to do, to get into thinking that this person's more right than that person, because they might be for a while, and then, as Charlie Munger said, these people come and go. By the way, if you it's entertaining, I said this is not advice, it's just entertainment. And speaking of entertainment, I have started the stocks with today with JJ channel, where I'm looking at these, reacting to daily videos on these news channels, and it's just being fairly critical because of these predictions. It is fun and entertaining, but I definitely point out the dangers of doing that along the way, and including Bitcoin and other stocks, and including Tom Lee and then Tesla and Nvidia and all that stuff. So if you're interested in that bit of entertainment, do follow along. I'm going to put a link in the description to that, and also over on Patreon, the Art of Value Patreon, I do weekly investing updates, things that I don't share anywhere else. Once a week I'm doing that, and also stock analysis, secret sauce I've started doing once a week. I'm sort of doing a course of mini snackable videos once a week there, going right back to the beginning in terms of investing. If you want to follow along with there, you can join as a free member, free subscription as well, where you get videos that don't have the same ads. They don't have ads like they do here, and also early access. I usually upload quite a few hours before there. So if you want to be involved in that, then I'll put a link in the description for that too. And thanks to everybody for watching or listening. This was a bit of a rant today about the folly of prediction. People can be right for a string and then wrong for a string, and a lot of people listen and follow along, and I think it's dangerous. That's my warning for today. Okay, thanks for watching, and I'll see you in the next one.